Hello everyone and welcome to another episode of the Candlestick course for beginners. This is episode number 12. My name is Mr. Crypto Tracker and I'm going to teach you how to trade with candlesticks. Before we start this episode, please make sure to subscribe to the channel if you didn't do it so far, and also turn the notification bell on to get notified when a new video comes. This video is all about 3 white soldiers and 3 black crows. We are going to explore these two interesting patterns and see how they can help traders to spot bullish and bearish reversal patterns in any financial markets. Let's take a look at what you are going to learn in this episode. You are going to learn the definition of 3 black crows and the signal they give, the pattern known as 3 white or advancing soldiers, and variations of the pattern, and how to use these patterns to spot bearish and bullish reversal on any more financial markets and on any charts. Let's start with this question. What is the 3 white soldiers pattern? This is what the 3 white soldiers candlestick patterns look like, as you can see in this slide. The 3 white soldiers is a bullish candlestick pattern that occurs near the end of a bear market. It signals the end of the prevailing downtrend. This candlestick formation consists of 3 green candles that signal a strong buying pressure, which leads to a trend reversal. This is a continuation pattern, and optimally, each candle should close at or near its top, as you can see here. Most traders who use Japanese candlestick charting techniques know that price action works better within the right context. Depending on where it develops within the trend, the 3 white soldiers can also be viewed as a continuation pattern. If these patterns forms in the middle of a bull market, it can act as a continuation pattern. When the pattern forms at the end of a downtrend, it acts as a price reversal signals. From a supply and demand perspective, the 3 white soldiers can help traders identify a shift in market sentiments where buying pressure surpasses selling pressure. Let's summarize the key characteristics of the 3 white soldiers pattern. 3 consecutive green candles with a large trading range. This is the first character. The candles are relatively the same size. The candlesticks have small upper and lower wicks. As you can see here, small, very small upper and lower wicks. The second and last candle lows cannot go beyond the middle price range of the previous day or the previous session. It can be a 4-hour session or a daily session, it doesn't matter. The opening price of each candle is within the height of the body of previous candle. The closing price of the second candle surpasses the first candle's high. You can see here. This is the first candle's high and this is the second one. The closing price of the third candle exceeds the second candle's high. Again, this is the close of the third candle, which is higher than the second candle. The next important question is how to identify the 3 white soldiers on any charts. Before you can correctly identify the 3 white soldiers, you need to know that this pattern is not tradable under any circumstances. There are several requirements that the 3 white soldiers pattern needs to satisfy. To qualify each instance of the 3 white soldiers candlestick, traders should be looking to incorporate into their trading a 3-step process. Number 1 is market context. The pattern needs to develop at the end of a bear market or in a downtrend. The second one is the size of the candles. The 3 green candles needs to be of substantial size, as you can see here, big size. And The third one is volume confirmation. We need to see an uptick in trading volume, and we need to see them in order to confirm the trend reversal. This is what we need to consider before decide to trade this pattern. Let's take a look at another example. As you can see, we have a clear downtrend here. After a long downtrend, we have a bounce. Then the price came back to the same support level again. And then these three white soldier candlestick patterns appeared here, as you can see, very close, or we can say at a support level. And if you want to trade this pattern after finishing the third candle, after the close of the third candle, if the price moved to the higher point of the higher place of if the price moved to the higher prices of the close of the third candle, then you can enter to a trade and put the stop loss below these lower price. But the most important thing here is the risk management. You have to manage your risk, and also it would be wise to wait for a possible pullback, and then you can enter in a pullback. This way you can tighten your stop loss, and you can enter at a better price. So I talked about risk management, and I want to give you a risk management warning in this slide. Managing risk, especially in the volatile cryptocurrency market, will help many traders keep their heads above the water where others have failed. As a rule of thumb, don't risk more than 2% of your portfolio in any given setup. The stop loss tend to be wider with the three white soldiers candlestick, as I talked already about it. And if you risk more than what you can afford to lose, you will get hit harder if the market goes against your position. And secondly, ensure that the candlestick pattern offers you at least a risk to reward ratio of 1:2, which means if you risk 1 unit or $1, your probable reward should be at least $2. If you don't have any clear idea about how you can develop a risk management system for your trading journey, I recently published a course on Udemy website. I will put the link in the description. In this course, I described all the important parameters in risk management. I talked about how to develop a money management system for trading, how to calculate the optimal fraction of capital to be risk in each trade. I talked about how to develop a trading journal to track the profit and loss. I talked about what is the risk of ruin and its role in money management, and how to calculate your trade size. I just put a coupon for my followers on Twitter and my subscribers on YouTube. You can find the link. If you use that link, this course will be completely free for you, and you can enroll in this course, and it's a lifetime course. You don't need to pay at any point in the future. And also, if you scroll down in this section, you can see the content, different videos. It's not a long course, it's a relatively short course, but I try to cover all the aspects of money management. So I highly recommend you to go and enroll in this free course. Okay, let's come back to our episode. The next pattern I'm going to talk about is three black crows pattern. The opposite pattern of the three white soldiers is the three black crows. The only major difference between these two patterns is that the three black crows form at the end of an uptrend. As you can better see here, it appears at the end of an uptrend. Unlike the three white soldiers pattern, which signals a trend reversal from bearish to bullish, the three black crows candlestick pattern signals a trend reversal from bullish to bearish. And the second point is, whereas three green candles represent the three white soldiers, the three black crows pattern is represented by three consecutive red candles. They are also relatively large in size, have small or no wicks, and the second and last candle highs don't go beyond the middle price range of the preceding candle. And the last point is the same warning regarding the candle size, location within the trend, and also volume applies equally to three black crows and the three white soldiers. Let's take a look at an example of three black crowns. As you can see, there is a clear uptrend here, and after that this pattern appears here. If you want to trade it, again, you can enter to the trade if the price dropped below the lowest point of the third candle, and you have to put the stop loss on the like a little bit above the highest price of the first candle. So this is for this episode. Please go on different charts and try to find these two patterns. And also it would be a good idea to go back to previous episodes, watch them again and try to practice them on different charts. See you on the next episode.